Welcome back to the channel, folks. This is Jason, certified financial planner and host of Fighting Words Financial. Today, I'm going to talk to you a little bit about the recent NIO stock dilution, the big dilution that's coming between now and March of 2021, and I'm going to tell you all the reasons why it doesn't really bother me that much. Now, before we get started, I should disclose that I am long both NIO and Tesla stock, and I have been since shortly after their respective IPOs. I initially started out with a small amount of shares, but in the case of NIO, that small amount of shares kept the stock on my radar, and I've added to that position over time when it was ridiculously cheap, when they had really bad times, especially in 2019 when they almost went out of business. It was almost throwaway money at that point. It didn't seem very real to me because it was so risky. Okay, so remember, guys, this is not advice aimed at any particular individual. I'm not telling you guys to buy, sell, or hold any security. Do your own research. Come to your own conclusions. This is just my personal opinion, and this is not advice aimed at any individual. Now, I think that before I dive into the reasons why further dilution doesn't really bother me or doesn't have me concerned at all, let's start out by being realistic about NIO. Lately, if you're a NIO investor, you've been seeing some headlines like this: disappointed NIO shareholders running away from stock after dilution. Or this headline: why investors should stay away from NIO stock for now. Let's face it, folks, NIO has challenges. It has real challenges in front of it. The stock is currently overvalued, and the price cannot be supported by fundamentals by any stretch of the imagination. At this time of the video, the stock price is in the $19 range. Number two, they don't manufacture their own vehicles, and at least for now, they've actually abandoned plans to build their own factory. NIO is a long way from profitability. In fact, the earliest estimates that I've seen for full year profitability are at least 2023. I'm thinking it's probably going to be, to be honest, I don't really believe those estimates, and I think it's going to be later. Number four, they have a lot of competition. There are scores of EV companies in China right now, native Chinese electric vehicle companies, and foreign competitors like Tesla and VW have been making serious moves in China for a few years now, establishing relationships with battery companies and building their own factories. Number five, NIO isn't even outselling Tesla in China. NIO is called the Tesla of China, but let's face it, Tesla is the Tesla of China. NIO only delivered 20,565 vehicles last year for all of 2019, while Tesla sold somewhere north of 42,000 vehicles. Now, NIO does have a lot of advantages in the China EV market too, which I covered in other videos, but I'm not really going to talk about most of those today. I'll leave a link in the description to my other videos on that. But I am going to address the reasons why this current dilution, while it does suck in the immediate term, doesn't really have me concerned about the long-term future of the company by itself. Look, don't get me wrong, this initially had me a little bit concerned, but not all that concerned because, like I said, I've been an investor in Tesla for a long time too. So I checked out a few very compelling videos on YouTube where the YouTubers did a really good job of making those videos. They were related to the recent NIO stock dilution, and to be honest, they were pretty alarmist. Now, I don't know if they did this just to create a sense of urgency, just to get those clicks, or they did this because they really believe that this NIO stock dilution is really all that important, but they didn't really understand or put this into scale in comparison with another company that has gone from ground zero to a major player in the industry, which is Tesla. And while their concerns did cause me some initial anxiety, because their points are valid somewhat and because the videos were done really, really well, I did some digging around in the history of Tesla and I made some comparisons and I came to a conclusion. If you were an early investor in Tesla, say in the 2010 to 2012 timeframe, you should probably approach NIO with the same mindset, meaning you should be cautiously optimistic but accept that there's a lot of risk in this investment. Look, I see a lot of potential in NIO and I'm definitely long. But in my mind, NIO, like Tesla was in 2011, is not an investment at this time so much as it is a speculative risk. I've only put at risk in NIO what I can afford to lose in its entirety. If I were to lose it all, it would hurt, don't get me wrong, but it wouldn't have that great of an effect on my overall portfolio and not much effect on my overall retirement strategy. Now, there are already people out there watching this video now scoffing at the comparison that I'm making with Tesla, but think, folks, really think and remember, the success of Tesla in 2011 was not guaranteed by any means. People did not have the same amount of respect for Elon Musk back then that they do today. A lot of folks invested in Tesla don't realize that the story of Tesla might have been very different indeed if the story of Elon Musk's other passion project, SpaceX, had not been rescued from certain and ignominious death by emergency funding from billionaire Peter Thiel. SpaceX almost died with a whimper when its third consecutive launch ended in disaster. SpaceX should have had a whole bunch of triumphant publicity. On their third attempt, the rocket was carrying the ashes of Star Trek star James Doohan, the guy who played Scotty, into orbit. He had just died. The payload ended up in the ocean instead. The disaster was all captured on video. The moment when two of the rocket stages separate and collide, sending the craft, Scotty's ashes, and SpaceX's first payload for NASA into an uncontrollable spin should have been the thing that killed SpaceX. But billionaire Peter Thiel swooped in the very next day as the company's first outside investor and rescued the company from fiery failure with basically an open hydrant of cash. When Elon Musk took Tesla public in 2010, this near failure of SpaceX was fresh on the minds of many investors, including myself. Elon Musk was not regarded then as the near messianic techno-oracle that he is today, and Tesla was seen in some ways as a pipe dream, and at best, just an unproven concept like SpaceX was. And just like NIO, Tesla was facing financial insolvency almost immediately after going public, and investors started seeing headlines like this. Is Tesla Motors running out of money again? This headline was from September of 2012. Not even 2 years after the IPO, and Tesla was gearing up for its second round of raising capital by dilution. Now, other than the scale of dilution, NIO's trajectory doesn't really look all that different from Tesla's. What is causing a lot of investor concern right now is the deal that NIO cut in March of 2020, so really March of this year. It was a short-term financing deal that rescued the company from what was almost certain death at the time, as NIO was having severe financial difficulties. Along with a $1.4 billion capital injection from the government of Hefei and Eastern Anhui province, NIO raised $235 million from the sale of short-term convertible debt to a variety of different Asian investment consortiums. It looks like they all got together and bought a share of this convertible debt, probably to mitigate risk. The deal closed sometime around March 11th of 2020, and the terms were that NIO would issue at no interest a convertible note that could be converted into shares at a strike price of $3.50 a share after an initial period of 6 months. September 5th, 2020 was the first day that these note holders were able to begin to convert their shares. Let's understand the scale of this deal though and the probable level of dilution. $235 million in convertible notes at $3.50 is 67,142,857 shares. Wow, that sounds like an enormous amount. And that conversion price seems ludicrous. Generally, convertible bonds are sold with much longer maturity dates and with a strike price that carries somewhere between a minimum 20 or 30% premium over current stock prices. Folks, there was no premium with this deal. So why was there no premium with this deal? Well, NIO was not exactly in a strong negotiating position. If you look at the price of NIO during this time period, the $3.50 strike price makes sense since that was the approximate price of NIO. For the folks putting up this money, this probably seemed like a very risky proposition. They were loaning money to an insolvent company that is losing money and has only produced a few thousand vehicles. The $235 million was going to make no interest whatsoever. The payoff would need to be pretty big in order to entice someone and in order to, justify all of that risk, which is probably why the terms look like they did. It was a desperation move on the part of NIO. But really, let's put this into context. At the time, there was no way to predict that the stock price of NIO would be anywhere close to where it is today at $19 a share. That is a several hundred times gain in less than a year. Now, NIO preempted the deal with the convertible note holders and performed a secondary stock offering very early in September of 88,500,000 shares to raise capital, roughly $1.5 billion in cash. That diluted shareholder equity, bringing the total number of outstanding shares of NIO to about 1,223,000,000. I think right now is a good time to address the fact that with 1,223,000,000 shares out there, with NIO the size it is and the production is, I think we can acknowledge right now that NIO is never going to have their stock at $2,500 a share like Tesla did a month ago. That's probably not going to happen because of how many shares are out there. Now, I think that the timing of this capital raise was entirely about preempting the additional 67 million shares that are going to be created over the next 6 months. They wanted to raise money before those shares came onto the market. So the folks that own this note are going to be converting those bonds over the next 6 months. 67 million sounds like a lot of shares, but when you add it to the number of shares that are already outstanding, the new 67 million shares will only equate to approximately 5.19% of the total float. In other words, 5.19% of the total amount of shares that have been issued. Now, both of these dilutions by NIO are not insignificant by any means. They are a big deal, but I don't think they're a harbinger of the imminent demise of NIO like some folks do, and I don't think they're an indication of financial malfeasance or mismanagement. And I think it's almost certain that more dilution is coming in the near future. In fact, it's probably going to happen every single year for a very long while until NIO reaches profitability and they're producing somewhere close to 1 million vehicles. You know, in my last video, someone left a very uncomplimentary comment about me talking about predicting the future and that sort of thing. Like, how do I know this is going to come true? You know, someone's going to make that comment too. Because raising capital by dilution and using those funds to pay for building factories, acquiring technology and talent, that is the path that Tesla has laid out for the entire electric vehicle industry. They are the ones that demonstrated that this course of action can get you on the path towards profitability in the electric vehicle world. NIO and everyone else who is going to be successful will follow this path if they want to have any chance of success at all. It's a fact that NIO has never self-funded its expansion through the sales of its vehicles. It just never has. After more than a decade of production, Tesla has just passed the 1 million unit mark, and they only did that last year in 2019. Tesla is the king of raising capital for expansion through dilution by equity offerings and convertible bond sales. By 2018, Forbes was already counting the cost. 19 billion raised and $9 billion of negative cash flow. In 2020 alone, Tesla went back to the well twice in 2 separate stock offerings, raising more than $7 billion. You probably don't even remember that they did this once in February, and they just did recently another $5 billion in September. The theme of Tesla going back to capital markets to raise cash and dilute shareholder equity was one that started early in their existence as a public company with a secondary offering of shares and convertible bonds in 2011. That tradition has continued almost every year since. Now, I couldn't find an article for 2012, but Tesla did raise cash that year with an equity offering and resumed hitting up the market in cash in 2013, with more than $1 billion raised from debt and equity issues. Again, in 2014, from a convertible bond sale. In 2015, Tesla raised $738 million with an offering of shares to the public. In 2016, another $1.46 billion in capital raised and more dilution. In 2017, $1.8 billion in high-yield bonds in August and $1.4 billion in March. In 2018, Tesla seems to have turned off the spigot for at least a year, but resumed dilution in 2019 with an additional $2.7 billion in capital raises and equity dilution. Finally, in this year, Tesla hit up the market, in 2020 twice for more funding for a total of $7 billion. If you look at this chart put together here by Bloomberg, you can see that Tesla has hit the markets for every year except 2018, and almost all of that will have had some dilutive effect on shareholder equity because they love convertible notes and convertible bonds. Note that also the number for 2020 is missing the $5 billion that was just raised at the beginning of September. So in total, Tesla has raised somewhere north of $29 billion through secondary equity issues, convertible debt or high-yield debt, without any real competition in the EV space since it went public, and most of that has had a dilutive effect on shareholder equity. So okay folks, the path that Tesla laid out is basically the primary reason that I'm not concerned about dilution at this time. There are a lot of things to be worried about in regards to the survival of NIO, but not dilution. It happened. It's going to happen over and over if NIO has any hope at all of prospering in the next decade as it fights for its very survival in a very competitive landscape. Tesla is going to continue to dilute, and NIO is going to continue to dilute through equity offerings. The concern over this round of dilution is nothing more than alarmism, folks. You can ignore it. The bottom line is that this is unavoidable. Dilution by equity issue is absolutely unavoidable. The capital requirements for building a successful EV company are just too high to do it by self-funding. If you're going to create a vast new electric vehicle industry in China, in the US, or anywhere in the world from nothing, from scratch, that has to be capable of producing millions of vehicles per year, it's going to be financed mostly through equity offerings and some debt. A brand new vehicle manufacturer created from the ether is not going to be able to now, nor will one ever be able to self-fund through vehicle sales, the construction of new factories, the research and development of great new technologies, the development and retention of talent. They will simply get out-competed and outspent by those who can raise capital and build production capacity faster. This is simply the age we live in. So stop living in fear of dilution. If you are long NIO, you are long NIO. If you are long Tesla, you are long Tesla. There is more dilution coming, and this is not something you should worry about. All right, folks, those are just my thoughts. If you have a different opinion, please let me know. You know I like the conversations we have in the comment section. If you like this video, please smash the like button, as they say, and subscribe. Have a nice day, and I'll see you next time.